Hey everyone, it's the Cognitive Trader here, and in this video, we're going to go over the Doji Candlestick Pattern. The Doji is one of the most important Japanese candlestick patterns. When this candlestick forms, it tells us that the market opens and closes at the same price, which means that there is equality and indecision between the buyers and the sellers. There is no one in control of the market. So in this example below, you see how the open and the close price is essentially the same. And then you have your lower shadow, which is your lower price, and then your upper shadow, which is your higher price. As you can see, the opening price is the same as the closing price. This signal means that the market didn't decide which direction it will take. When this pattern occurs in an uptrend or in a downtrend, it indicates that the market is likely to reverse. So Doji represents reversal, it represents indecision. In the other example below, we can see how on the left we have various candles that are heading in an uptrend. And then we have the Doji candle, which is highlighted in red for you, which represents a reversal. And then you see that the uptrend gets changed into a downtrend. So the chart above shows how the market changed direction after the formation of the Doji candlestick. The market was trending up. That means the buyers were in control of the market. The formation of the Doji candlestick indicates that buyers are unable to keep price higher and sellers push prices back to the opening price. This is a clear indication that a trend reversal is likely to happen. Remember always that a doji indicates equality and indecision in the market. You will often find it during periods of resting after big moves higher or big moves lower. When it is found at the bottom or at the top of a trend, it is considered as a sign that a prior trend is losing its strength. So if you are already riding that trend, it's time to take profits. It can also be used as an entry signal if it is in combination with other technical analysis. So the next type of doji pattern is the DragonFly Doji pattern. The DragonFly Doji is a bullish candlestick pattern which is formed when the open, high, and close are the same or about the same price. When characterized, the DragonFly Doji is the long lower shadow that shows the resistance of buyers and their attempt to push the market up. So in this image right here, we see the DragonFly Doji. And as you can see, the open price and the closing price are at the top of the dragonfly, and it has a long tail as the lower shadow. So this, when you're thinking about the psychology of this candle, so essentially you have the sellers that came in and they tried to push it all the way down, but then the buyer stepped in and then pushed it up, which gives you the DragonFly Doji. So sometimes there's an upper wick, but in this example, there's no upper wick, but sometimes you can see an upper wick. The illustration above shows us a perfect DragonFly Doji. The long lower tail suggests that the forces of supply and demand are nearing a balance and that the direction of the trend may be nearing a major turning point. So we can see the example below that indicates a bullish reversal signal created by a DragonFly Doji. So we can see here that we have a downtrend, then we have this DragonFly Doji present here, and then it pushes everything up. In the chart above, the market was testing the previous support level that caused a strong rejection from this area. The formation of the DragonFly Doji with the long lower tail shows us that there's a high buying pressure in the area. If you can identify this candlestick pattern on your chart, it will help you visually see when support and demand are located. When it occurs in a downtrend, it is interpreted as a bullish reversal signal. But as I always say, you can't trade candlestick pattern alone. You will need other indicators and tools to determine high probability DragonFly Doji signals in the market. So the next Doji candlestick pattern we'll review is called the Gravestone Doji. The Gravestone Doji is the bearish reversal of the DragonFly Doji. It is formed when the open and close are the same or about the same price. What differentiates the Gravestone Doji from the DragonFly Doji is the long upper tail. The formation of the long upper tail is an indication that the market is testing a powerful supply or resistance area. So we can see in the example below, we have a Gravestone Doji, which is a bearish candlestick pattern. So here you can kind of see the psychology of what's going on. So the buyers came in, they pushed it all the way to the top here, and then the sellers were stronger. They flexed their muscles and they pushed it all the way down, and then we have the opening and the closing at the bottom here. So the image above illustrates a perfect Gravestone Doji. This pattern indicates that while buyers were able to push prices well above the open, later in the day, sellers overwhelmed the market, pushing the price back down. This is interpreted as a sign that bulls are losing their momentum and the market is ready for a reversal. So here we have another illustration. So we have an uptrend, and then we have a Gravestone Doji. So you see the open and the closing price. You see the long upper tail, upper shadow, and then we see prices pushing downwards. The chart above shows a Gravestone Doji at the top of an uptrend after a period of strong bullish activity. The formation of this candlestick pattern indicates that buyers are no longer in control of the market. For this pattern to be reliable, it must occur near a resistance level. As a trader, you will need additional information about the placement and context of the Gravestone Doji to interpret the signal effectively. This is what I will teach you in the next chapters. So this concludes the end of this section. If you found this video helpful, please like it and share it. Thank you.